During Monday's Asian trading session, spot gold continued the sharp decline from last Friday, coming under renewed pressure in the session. After significant fluctuations, the price maintained a weak oscillating pattern, with market panic intertwined with profit-taking pressure, and the short-term trend of gold prices remained weak. Spot gold fell $165.58 from the previous trading day, a decline of 3.39%, and once dipped to a low of $4,581.90 intraday, with the maximum single-day decline exceeding 5%. After breaking below the $4,700 mark, short-term support quickly evaporated. The sharp drop in gold prices was mainly driven by the resonance of multiple bearish factors. First, U.S. President Trump nominated former Federal Reserve Governor Kevin Warsh to serve as the next Federal Reserve chairperson. The market regarded this as a hawkish signal, triggering expectations of monetary policy tightening. And the strengthening of the U.S. dollar index directly suppressed the performance of gold prices. Second, the rapid rise in gold prices in the early stages accumulated a large number of profit-taking orders. Last Friday's plunge triggered margin calls in high-leverage accounts, leading to chain selling, and the selling pressure continued to be released during the Asian trading session. Third, there were signs of easing in geopolitical situations such as the Middle East, and market safe haven demand cooled rapidly, further weakening the upward momentum of gold prices. From a technical perspective, gold prices have continuously broken below multiple key support levels, with the $4,700 mark turning from support to strong resistance. In the short term, the first support below is focused on the $4,500 integer mark. If this level is broken, it may further decline to the $4,400 range. For resistance above, attention should be paid to the $4,800, $4,850 range. If the short-term rebound fails to break through this range, the weak pattern will be difficult to reverse. In terms of indicators, the MACD indicator continued to diverge downward, and the KDJ indicator was in the oversold range, but had not yet shown obvious signs of reversal, indicating that short-term bearish forces still dominated, with only a small chance of a technical rebound. However, there are certain supporting factors in the market. The trend of global central banks continuing to increase their gold holdings remains unchanged. Institutions such as UBS and Bank of America still maintain an optimistic outlook on the long-term trend of gold prices, believing that the decline is a correction of the previous overheated market, as long as the Fed's general direction of monetary easing remains unchanged. The foundation for the gold bull market still exists. In the short term, the trend of gold prices still needs to focus on Fed policy signals, changes in geopolitical situations, and the trend of the U.S. dollar index. And blind bottle hunting should be avoided. All content is for reference only and does not constitute any investment advice. If you trade based on this content, you should bear your own profits and losses. Please subscribe, like, and share. Thank you for watching.